Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about investing in emerging markets. So quite often, stock markets are either classified as developed markets or emerging markets. And emerging markets tend to have significantly better growth prospects than developed markets do. And probably these growth prospects are best reflected in Standard Charter's projections, which Standard Chartered is a very well-respected global bank, and they predict that the GDP produced, a gross domestic product, which is really a measure of a country's economic output, produced by both China and India, it's expected to triple between 2017 and 2030, which is a pretty amazing fact. And in fact, at the moment, China's GDP is a little bit more than the US, but it's projected to be, by 2030, more than double the US. So, that market is projected over the next 13 years to go through a massive growth phase. And in fact, a lot of this data is backed up by multiple sources. So the International Monetary Fund predicts that emerging market economy growth rates will be nearly 3 times that of developed economies. So I thought it'd be a good juncture to sit back and say, okay, well, if we want to invest in higher growth markets, how do we do that in a safe and sound way? So as I said at the beginning, stock markets are either classified as either developed markets or emerging markets, and you'd probably be most familiar with developed markets. Developed markets tend to have a more robust and reliable financial system. So, things like the country must be open to foreign ownership. There's ease of capital movement, so that he's getting money in or out of the country. You've got efficiency of market institutions and government disclosure and regulatory regimes aimed at providing investors with reliable and trustworthy information. So that is, it's developed, it's less risk. You're going to get transparency and reliable and timely information in order to make your financial decisions. So global economies obviously include the US. That makes up 62.8% of all developed markets. Japan, which is 8.4%. UK, 5.5%. France, 3.8%. Canada's about 3.3%. And then there's 18 other countries that are included as or regarded as developed markets. Europe, most European, Western European countries, etc. And of course, Australia's in there as well. We make up slightly less than 2% of global developed markets. Whereas emerging markets, they tend to be obviously less developed. There's not as much transparency, oversight, regulation. Foreign ownership might be an issue. Ease of movement of capital might be an issue. And so therefore these markets tend to represent slightly higher risk. The largest emerging markets include China, which is 33%. It's a big part of emerging markets. Korea, 13%. Taiwan, 11.4%. India, 9%. And again, there's another 22 countries that make up the remaining. It has a very long tail, just like developed markets. If you have listened to this podcast or been reading my blog for some time, you'd be well aware by now that I'm a fan of passive index investing as opposed to active investing. Passive investing is a very low-cost, diversified way of investing in a particular country, a particular market, or a particular asset class. So, if I want to go and invest in the UK market, for example, or the US market, I can employ various different indexing strategies that allows me to do that. But the common theme between those strategies are that they're very low cost. They're rules-based, which means they're really evidence-based because we can see how they would have performed if we had implemented the same investment rules over the last 30 years. And they're very transparent and very diversified. And really diversification, particularly in developed markets, is a real key in order to producing good quality long-term returns. Also, the evidence is overwhelming in terms of index funds in the long run producing better outcomes, so better returns. And in the most recent data prepared by S&P Dow Jones, which is an index fund provider, only 16% of active fund managers beat the Australian market and 11% beat the US market over the past 15 years. So it's not very compelling. And in fact, that data is a bit deceptive because you go, well, 16% beat the index over the last 15 years in Australia. That's not too bad. But actually, it's not the same 16% naturally. You know, the outperformance doesn't or rarely persists for more than 2 to 3 years. So over that 15-year period, the fund managers that were in that top 16% are going to be different, which means that you need to, when you need to find the next best, active fund manager and know when to, jump off the ship and when to invest with them. So as a general rule, active funds management is a bit of a flawed strategy. It's expensive. The overwhelming evidence that suggests that it's not going to work, so you go with indexing. However, when it comes to investing in emerging markets, indexing doesn't perform as well as it does in developed markets. Obviously, because as I previously explained, the hallmarks of a developed market is that you can probably assume that the market is going to accurately value companies in the long run in a developed market. You can't necessarily make that same assumption in emerging markets. So as I said previously, one of the hallmarks or one of the key consistent things you want in a developed market is diversification. And that's because what you don't invest in, what you miss out on, is probably what's going to hurt you in a developed market. Whereas in a emerging market, the key is to avoid the poor quality companies because you don't necessarily have that transparency around, the reliability of the information that's disclosed by companies. So you can get caught out if you're investing in something that's overvalued, or something or a company that doesn't actually have the growth prospects that you might otherwise see. And so therefore, a better approach when investing in emerging markets, in my opinion, is to actually employ active management. You want to, in my view, employ what's called a high conviction active manager, which means that they're very selective about what they invest in, and they might have a portfolio of 15 to 20 stocks. But they're going to pick the eyes out of the 15 to 20 best stocks that are available within an emerging market, having consideration to sort of geopolitical risks and so forth. So you want to make sure that what the government is trying to do in a particular country is going to not contrast with what the company wants to achieve. So natural gas was something that China wanted to pursue, and I know one of the active fund managers that we use invested in a company that was a natural gas retailer in China and has been connecting literally millions of households per year. Well, the Chinese government was a big push from the Chinese government, and the fund managers recognise that, and that's a good example of how, if you're being really selective and making sure that you're investing in good quality companies that have high growth prospects at a fair price. The other thing to take note of is what I'd probably call the President Trump effect. And that is obviously, you'd be well aware that there's US sort of China trade tensions, talks and so forth, introducing tariffs, playing that sort of political game in regards to international trade. And stock markets, as a general rule, don't like uncertainty. And typically when there's uncertainty hanging around, typically stock markets fully price in worst case scenarios. And it's certainly what's happened, I think, with emerging markets at the moment. So they're undervalued compared to their longer term trend. And if you look at the KP ratio, which is a good forecaster of longer term returns, Research Affiliates, which is a US research house, suggests that there's a 90% probability that over the next decade, emerging markets returns will be somewhere in the range of 4.3 to 11.1%. Big range, but obviously there's a volatility uncertainty there, but essentially showing that really of all the markets that we could invest in, emerging markets are potentially going to have the best returns over the next decade, plus also potentially because of this Trump effect, because of this US-China trade tension, emerging markets are valued at lower multiples than they have historically been over the longer term. Over the past 5 years, so what returns have there been? So over the past 5 years, the managers that I prefer to use by the name of Martin Currie and Fidelity are a couple of examples, have produced double-digit returns in the range of 11 to 12% over the past 5 years, which compares favourably. If you have a look at Vanguard's emerging market fund, it's done about 7.5% over the same period of time. So I guess that demonstrates there the difference between indexing in emerging markets and active funds management. It's also possible, if you want to be a little more aggressive in your emerging market investments. And one of the funds I really like invests in the top 50 tech companies within Asia. As you can imagine, if you look at that GDP growth and also the population growth, the urbanisation of population in both China and India, it potentially provides really strong growth prospects for technology companies because they're obviously highly scalable, leveraged businesses. And so BetaShares, a fund manager, BetaShares has a product that invests in the top 50 tech companies such as Alibaba, Samsung, Taiwan Semiconductors, and a gaming company called Tencent, which is all these companies are incredibly valuable and are valued at lower multiples than their counterparts are in the US. So therefore, they're representing value, they've got growth, and they've got strong quality fundamentals as well. Of course, please don't go out and start investing in a fund that's run by Martin Currie or Fidelity or BetaShares or so forth. You must get independent advice. I only share these names with you just to give you examples of the types of investments that I'm talking about. In fact, emerging markets typically exhibit higher risk than developed markets. Volatility is high, which means prices can change quickly and there can be large movements. So I would typically not invest any more than 5% of a portfolio in emerging markets, unless it was money that you were, dare I say it, happy to lose. Unless you're very, you've got a strong risk appetite, then typically 5% or less of your money of your portfolio should go into emerging markets. And really, your portfolio really should be a diversified portfolio of mostly developed share markets and also bonds and so forth. So if we think about it, just to wrap up, over the past century or more, global wealth has really centered around, firstly Europe and then the US. However, if you think about the next 13 years and these projections, say by 2030, the Chinese and Indian economies are projected to be significantly larger than USA, somewhere between 1.5 to 2 times larger, both those economies, which they haven't been certainly in the past. And that's a tremendous amount of growth over what is a relatively short period of time. And I can't help that think that Australia will, just because it's located in close proximity and in very similar time zones, Australia is really well positioned, excuse the pun, to benefit from this tremendous growth that's going on around us. But also, it's a good time to start thinking about whether your investments are also well positioned to enjoy some of that growth. And in an astutely structured, diversified share portfolio, I think certainly now is a great time to start considering emerging markets, just because of where the starting valuation point is, but making sure you get that right, but without overexposing the portfolio to too much risk. So as always, there's more in the blog and the show notes to the podcast episode. Also, I've got on the website a graphic that illustrates the growth in GDP of those emerging markets and some of the developed markets around the world. It's kind of an interesting chart, so certainly have a look at that on the website, on the blog page. Until next week, that's it for me. Bye for now.